Did you know that smart crypto investors rarely put all their money into one coin? Sounds obvious. It's the difference between riding the waves and getting wiped out. Let's break down how diversification actually works in crypto. Quick, simple, beginner-friendly. First up, what is diversification? It's spreading your money across different assets so one bad bet doesn't sink your whole portfolio. Think of it like not letting a single coin decide your future. Types of crypto assets people use to diversify. Large coins, Bitcoin and Ethereum. Stablecoins, USDT, USDC, DeFi projects, lending, trading, yield platforms, utility tokens, access, governance, rewards, Layer 1 blockchains, Solana, Avalanche and others. Why does diversification matter? Crypto moves fast and hard. When one asset drops on bad news, others might hold steady or even climb. Diversification smooths the ride and reduces single project risk. It keeps you in the game long enough to benefit from winners. It won't eliminate risk, but it can help control it. Example portfolio. For learning, not advice. 40% Bitcoin, 25% Ethereum, 20% stablecoins, 15% other altcoins you've researched. This balances core conviction, cash-like stability, and growth bets. Final tip, define your risk level, rebalance periodically, avoid chasing hype. Diversification only works if you stick to it. Bottom line, Dawe and stay ready for market changes. If that helped, subscribe for simple crypto guides and tips. See you in the next one.